All right, folks, it's showtime. Hi, everyone. Let's start this webinar off as we usually do with a question. Are you going to be able to retire in a way that you are comfortable with? What do you think most people's answer to this question is? Well, according to a Finance Buzz survey released in January 2020, 35% of Americans have no money set aside for retirement at all. Why do you think this is? Well, of course, many of them just aren't making enough to save, but I believe that a good percentage of them would if they could wrap their heads around the fact that it is possible for them to accomplish this. If they understand that what is needed to achieve this goal is really not out of their reach. And this is what I have committed my life to as a financial advisor. I am the eternal optimist when it comes to us all meeting our lifetime financial goals. And this is what we're going to discuss today on this webinar. We're so excited to be doing this with you today because our topic is introducing investing. And it's only the second time that we have covered this topic since we committed to doing a monthly webinar 15 months ago in March of 2021. Imagine that, Rach. It's been 15 months since we started. So with that said, we have two goals for this webinar today. First is to educate you on the fundamentals of investing. And secondly, to discuss the different types of investing strategies that are available to us all today, and especially the ones that we as a firm are gravitating towards these days and why. It is exactly these strategies and our approach to financial planning that we think separates us from the pack when it comes to this topic and what we do with our clients. But before we do that, I want to thank each of you for joining us today to discuss this extremely important topic. My name is Brian Dougherty of PLC Financial Solutions, and I'm your host along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel. She'll be our moderator for it, and she will be handling all of your comments and questions as we move along. But before we get started, let's take care of some general housekeeping first. First, if the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen, one called Chat, it's for your comments, and the other called Q&A, for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you will have questions about the material we will be covering today. But since we have a good bit of it to cover and only an hour or so to cover it, I'm going to ask you to put your comments and questions in those boxes below. And at the end, we will be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link at the end for you to schedule that. Next thing. This webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it all out at your convenience. Also, because we want to make sure that you're all paying attention and because we'd like you to have some fun as well, before we answer any questions, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure you have a notebook handy to jot down some brief notes related to some special bullet points that I'll be pointing out as we go along. And finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got that over with, I have one for you, as always. So a hamburger walks into a bar and orders a beer. Bartender says, "Sorry, we don't serve food here." I got that myself. The kids didn't come up with that one. It's probably all the more reason why I should keep my day job. All right, let's get started. Okay, well, let's see. So, what does it mean to invest? Well, most of us know someone who was either born into or stumbled into financial security, and it's hard not to want that for ourselves. But the reality is, for the rest of us, financial security is not a given, and waiting around for a windfall is certainly not the responsible way to go about it. So it's our responsibility to attain it on our own. However, please don't get overwhelmed because our goal is for this to show you how to have the money you're already making work for you in the future. That is investing. You don't have to be a market wizard to obtain financial well-being. You just need to learn a few basics, form a plan, and vow to stick to it. Investing is not a get-rich-quick plan. It is a long-term investment in your future. There is no guarantee you will make money from all the investments you make. But if you understand the best ways to invest and save, you should be able to grow your financial security while learning the benefits of money management. Okay, you guys ready to dive in? Let's do it. Now, there are many ways to invest your money. You can own a business, buy a property, or even buy collectibles for that matter, which can all potentially bring high yields over the long term. This, by definition, is what investing is. And of course, if done right, they can all be wonderful ways to invest for your future. However, today we're going to be discussing investments that revolve mainly around the stock and bond markets. So, you guys intimidated yet? Well, you shouldn't be, because even the best investors in the world had to start somewhere, right? So let's get it. Now, whether you're just getting started on your own, at the height of your career, planning your retirement, or approaching your golden years even, let me tell you, it's never too early or too late to start investing. And the best place to begin is with two basic questions. First, where do you begin? Second, how do you begin? These questions in and of themselves can actually be a little overwhelming for some people. There's a lot of information out there, and the investing world's terminologies don't necessarily bring much comfort to people either. Words like portfolio, market capitalization, return on equity, etc., etc. None of them actually scream, "Welcome to the investment world." But don't fret, because all you have to do is want to learn, and you will definitely get there. Okay, so let's start out by looking at how the stock market works with the economy to help you better understand your risks. So when it comes to the stock market, it pretty much goes hand in hand with the economy. And contrary to what most people think, especially right now because it's been down lately, it's actually fairly consistent despite the swings you hear about on the news. And these days, there seems to be a whole heck of a lot of swings that we're hearing about. With that said, you have to understand the big picture when it comes to it. And that is that the markets and the economy work in cycles together. And here's the three basic components that they break down into over time. The first cycle is known as the productivity growth cycle. Now, this is started by an increase in the labor market, or what's known as input into the economy. So people are making money, and by making that money, they start inputting money into the economy, which then causes revenue and the gross domestic profit in our economy to increase. This is also known as output from our economy. When this happens, money flows more heavily into our markets, both stock and bond markets. The next cycle that evolves from this is the short-term debt cycle. This cycle is defined by a growth period and then a recession period that usually lasts roughly around 5 to 8 years. And it will account for both a boom and then a bust at some point in time in the markets. It peaks when interest rates go up as loans become more expensive, and then busts when debt payments become higher than people's income or ability to pay their debts, thus causing a recession and resetting our economy and markets at lower levels, which then begins the cycle all over again. Now, the final cycle is what's known as the long-term debt cycle. It works very similar to the short-term cycle because it has a boom and a bust as well, but it's a bigger and it takes longer for the cycle to go through, typically around 50 years. Now, it peaks when the economy has high debt and cannot take on anymore, which means the economy cannot continue to lower interest rates anymore. That sounds a little familiar these days, right? Hopefully not that familiar. The result is that large amounts of debt unwind and the market will correct anywhere from 40 to 50% or more historically. And as you well know, it causes a lot of loss to lenders and to investors as well. Think of the roaring 20s versus the bottom out of the 30s and 40s, Depression era, or even our 2008 Great Recession. However, they are not all exactly the same, and there's usually several catalysts that are unique to the situations as well, which we well know with those situations. With all that said, all you have to do is understand that these cycles have been going on since the inception of our markets, and that investing for the long run has always proved to pay off in spite of them. Then, once you do, the fluctuations in the markets are not as scary as they sound. In fact, once you do, you can even start to use them to your advantage if you're so inclined. Okay, so what is a portfolio anyway? For many of us, the word portfolio brings to mind scary interviews or long nights compiling our life's work into a comprehensive presentation. But in the financial world, your portfolio is simply the things that you own. It includes things like your retirement accounts, investment accounts with stocks, bonds, commodity investments, those types of things, real estate, even business assets. Really, whatever it is that you own. Often people are at work building a portfolio without even knowing it. But having a clear vision of your portfolio is a good idea because the idea is to create a balanced portfolio that limits your losses should you lose on any aspect of it. To do that, it's a good idea to diversify. Also, when it comes to diversification, it's not only a very good idea to diversify the individual investments inside a stock or bond-based market portfolio. It's also a good idea to invest in assets that do not correlate very much with each other when it comes to them as well. Things like real estate, commodities, art, collectible stamps, baseball cards, etc. Even wine can be considered a non-correlated investment asset or investment. In fact, these days, even certain types of investment-based annuities are even used as non-correlating investments. Bullet point. Diversification is the #1 most important rule to investing. I'm going to say that again. Bullet point. Diversification is the #1 most important rule to investing. And why is it so important? Well, remember the great bust of 2009 that resulted in a near collapse of the global financial economy I just was talking about? That recessive period also meant complete financial annihilation for an incredible amount of private investors that tried to take advantage of the boom just before the bust happened. However, the problem for so many of them was an imbalanced portfolio. Essentially, they put too many of their eggs in one basket and lost it all or too much of their investable equity in something that took a turn for the worse. Now, the best way to protect yourself as an investor is to diversify. You don't want all your money, for instance, to be tied up in a house, because while it is a significant investment, it could flood, or the housing market could plummet, or the mortgage could become too much to pay. If you were to lose the house for some unforeseen reason, and it's the only asset you have, you stand to lose everything. But if you have other investments, a 401k, bond, stocks, a business, etc., you'll have a softer landing. The same could go for putting all your money into a single stock. Why risk it all when you can spread it out for better protection? Now that reminds me of a story of a client of mine who had half her investments tied up in her company stock right up until a year or so before she retired. So we, of course, rolled it over into a diversified portfolio in order to mitigate her risk. What was crazy about it was that just about 6 months before she retired, her company's stock price fell almost in half due to the market conditions. Let me tell you, we were unbelievably relieved that we had the chance to do something about it before that happened. Woo! We were partying. Yeah, it was like, yeah, high five. But really, it was just hapstance. So now let's talk a little bit about charting your financial future. Okay, so the first step to investing is getting clear on your goals. Of course, we all want a bigger return on our investments. That is a given. But for you personally, you have to ask yourself, why am I looking to invest for the long term? Or what am I looking to invest for? Before we get into your investment options, let's look at some important questions you need to ask yourself before getting started. The first is, why are you looking to invest? You need to determine if you're focusing on safety, income, or even growth. Second, how much can you realistically set aside? This is going to involve putting together a budget to see what you have left over that you can use to invest without compromising your current financial responsibilities. Now, third, when will you need this money again? You're going to need to decide if you're saving for retirement long term, or if you're saving for a car or a down payment on a house short term. That's all important stuff. Now, Next is how much risk are you willing to take, or can you tolerate, or can your situation tolerate? Knowing this will definitely help to determine what types of investments are right for you. Now, finally, what should you invest in? And that's why we're here today. So, for instance, if you sold your house and you're looking to, if you're selling your house and you're looking for a new house within the next 6 months or a year, you don't want to put that money into the stock market while it's sitting and waiting for the new house to be found. You want to put it, you want it to be invested in either cash or cash equivalent type of investment, like a short-term bond fund with low fees, or even a high interest savings account, something along those lines. So now let's look at your options. Bullet point two. Did I emphasize that enough, Rach? One of the first options for many people is a 401k at their work. If you work for a company offering an employer-sponsored retirement plan, also known as a 401k, there's others called 403bs for nonprofits and whatnot, but they all work kind of the same. This is a great opportunity to start your financial savings plan. Employee 401k contributions based on an income percentage you decide on are automatically deducted each pay period prior to taxation on gross earnings. Often employers will even match employee contributions, which I greatly encourage at least up to the match in order to get the free money. So I would at least invest in that up to the amount your employer will contribute. So say your employer offers 100% match up to 3% of your salary, and you earn, say, $50,000 a year. Then the first $1,500 you contribute in your first period of deductions will be matched by your employer for a total of $3,000 paid towards your retirement. Now, to grow your retirement savings more effectively, you will need to invest the money that you're contributing to your 401k. Usually, there are default options recommended with every 401k, or you can also choose your own optional investments from a list of other funds that they provide. Either way, a 401k is a very nice option because you can gain on your investments with no risk of losing what you have contributed due to a lack of discipline. What do I mean by that? Well, that's because there are rules that most employers impose on the funds inside their plans, which usually restricts, if not impedes, an employee from taking their savings until they've reached at least a certain age or have retired fully, thus not allowing folks to take funds when the market is down most of the time, unless it's down when you're retiring. Okay. Now, say a person started saving in a 401k at age 22. Check out the chart here to see what they can expect to gain in a 30-year period. If they started with 5K and they only contributed $200 a month, you can see that a small amount can add up to a pretty sizable savings over that time period. The chart shows a one-time 5K investment with then $200 a month, which is $1,200 a year, or $2,400 a year, for 30 years. Will accumulate to $284,000. I've actually shown some of my clients that are in their early 40s that just by maxing out an IRA at 6K a year, which is $500 a month, or $125 a week, until age 50, then 7K until retirement age of 67, because they allow you to have a catch up of $1,000 more after age 50. They could have over $550,000 at a 7% annual return, which historically the market has done or better. So it doesn't take for a person to be rich to retire comfortably, especially when you do add Social Security to this mix. Bullet point three. Okay. An IRA, individual retirement account, is also a great retirement plan option if there is not an employer-sponsored plan available to you. Similar to a 401k plan, an IRA offers tax-deferred growth on your investment, which simply means that your contribution will not be taxed until you withdraw the funds, preferably at retirement. Now, there are two options for IRA funds. There's a traditional IRA. A traditional IRA may be a good choice for anyone with earned income under the age of 71 and a half. Actually, we're going to say, and it may be tax deductible based on your income. With this option, you avoid paying taxes on your contributions, but will pay taxes when you withdraw based on current income tax rates at that time. The second is also what's known as a Roth IRA. Now, a Roth IRA does not have any age restriction, but is only income eligible. The current restrictions are that contributions must have a modified adjustment. The contributors must have a modified adjusted gross incomes between 125,000 and 140,000 for a single person, and 198,000 to $208,000 for a married filing joint to contribute to a Roth IRA. This option taxes contributions as they are made, so it's they're made. The taxes get taken out before the contributions, which means there is no additional tax paid when you withdraw. Note, here are the traditional IRAs without ranges for 2021. So I need to update this, 2022. 66,000 to 76,000 for single taxpayers, 105 to 125 for married couples, filing joint. Now, this applies when the spouse making the IRA contribution is covered by a workplace retirement plan. So they do have a little bit of detail to who can contribute and under what amounts they can do it under. But they are also an excellent option for saving for retirement, both a traditional and a Roth IRA. Now, what are stocks options? So we're not really talking about stock options. That's something different. What are our stock options? So stocks are called shares and equities. There's another word you'll hear. Now, they're investments that represent a percentage of ownership in a company. If you purchase a stock in a company, you actually become a shareholder. Your rights as a shareholder may include receiving dividends, which are company profits shared with shareholders, and even voting rights. However, your investment does not give you right to any company assets. Now, stocks are made available by companies who issue shares as a means to raise large amounts of capital to grow their businesses, which in turn leads to higher profit return and ultimately more money paid out to shareholders. Now, if a company you are invested in goes bankrupt, assets can be sold to repay debts, but stockholders are the last investors to receive anything. So you could lose on your investment in the worst case scenarios. So when it comes to stocks, there are different types you can buy. Let's delve into them a little bit. Bullet point four. Remember, take that note. There are two main types of stock. Two main types of stock. Common stocks, as the name suggests, common stocks are the quintessential stock that most people refer to when talking stock investments. Common stocks offer shareholders dividends and the ability to vote on corporate matters, such as the board of directors. Now, there's also preferred stock. That's the other type of stock. Preferred stocks work a little differently, actually. Shareholders typically do not get a vote with shares with preferred shares, but in exchange for voting rights, shareholders get paid first when the company pays dividends. So that's a good thing. Get paid before everybody else, right? Like that. Now, common stocks are generally riskier than preferred because if a company declares bankruptcy, shareholders are typically last to receive payments after debts are paid. Whereas with preferred stock, shareholders are typically paid first. So that's nice. However, if you're considering purchasing any individual stocks for your portfolio, I highly recommend that you consult with either a professional stockbroker or an investment advisor who is well versed on analyzing stock for its investment potential. There are many important metrics and considerations that are related to a stock before you invest into it. Things like the price to earning ratio, the earnings per share, the market capitalization, the volume traded, the dividend yield, etc. It goes on and on and on. There are hundreds, actually. Okay, just to name a few. So it's very easy to buy a good stock at the wrong time. And thus it may not end up being as good an investment for you. So be very careful when considering investing in an individual stock. I will tell you this as well. It's been my experience that almost all stocks, individual stocks, fall in value when the stock market in general or as a whole falls. Also, normally in the USA, the stock market, so you know, is represented by the three most popular stock indices, which are the S&P 500, the NASDAQ, and the Dow Jones Industrial Average Index. However, after falling with those markets, not all stocks will go back up with it in unison. In fact, most will lag behind it somewhat. That's been my experience. As a result, it can be easier for individual stock to lose with the market, but not gain with it. This can be very frustrating for individual stockholders. And I know this personally, believe me. Okay, bullet point 5. Bullet point. All right. Another very common investment option that is part of most portfolios is a bond. Unlike stocks that are equity investments, bonds are debt investments. A bond is a debt investment that entails an investor loaning money to a corporate entity or government. The funds are borrowed for a set period of time at a variable or fixed interest rate. Bonds are often considered a guaranteed moneymaker because they are very low risk. They're a very low risk option for investors. However, when bonds are issued by a company, the investor, aka lender, typically gives the company a set amount. Let's say $1,000. And that's known as the face or the par value of the bond. And in turn, the company promises to pay the investor a certain interest rate, known as the coupon rate of the bond. And they pay this every year. In addition to repaying the initial $1,000 loan or par or face value amount back to the bondholder when the bond matures. So you not only get that interest, it's usually biannually, to a year, but you also get the original investment back if you hold it to maturity, which can be any given time. For government bonds, it's can anywhere from a month to 30 years. Okay, say we invested that $1,000 in a 30-year bond. This time span is known as the duration of the bond. And say it's a 5% interest rate or coupon rate. That would mean a $50 payment each year, usually two $25 payments. And then at the end of a 30-year period, the $1,000 is returned. Bonds have historically been the preferred option for balancing a portfolio because they help lessen the overall portfolio risk and provide an opportunity for consistent gains. They're also less volatile than stocks. And if you hold them until they mature, you'll receive income and principal payments, though market value will vary along the way. Of course, there are still some cons to choosing bonds as your investment option. As is most things, there are both pros and cons when it comes to investing in bonds. Let's take a look. Pros. Bonds are fairly safe investments designed to provide you with regular pre-scheduled payments. If it is a corporate, not a government-issued bond, and the company declares bankruptcy, you'll be one of the first to receive compensation once the company's assets are liquidated. Even if interest rates decline, you are still guaranteed the higher rate. Cons. The interest payments from bonds are taxed higher than all other investment income. They are taxed at ordinary income at income tax levels, as ordinary income at income tax levels. Now, if interest rates increase, you'll be tied to the lower interest rates. So if you're currently receiving 2% and the market rates increase to 3%, which has been going on now lately, you're still locked in at that 2% rate. As a result, if you need to sell the bond, you will have to sell it at a lower par or face value. This is also known as a discount rate, and it will cause your investment in that bond to lose value on your return. Now, you do not stand to make as much money as you would with a riskier investment like a stock. So it is important to create a portfolio that incorporates bonds in a way that meets your own personal risk, your own personal risk tolerance of it. Now, bonds were at an all-time low in 2020. The Fed fund rate that most influences the interest rates of bonds was between 0 and 0.25% at that time. Federal Treasury bonds at that time were only bearing 1 to 2% margin over this rate. However, the Fed has decided that they need to aggressively increase rates recently due to the recently high inflation rates that we have seen. So currently they're at 3.2% for a 10-year and 3.31. These are yesterday's numbers for a 30-year Treasury bond. As a result, it has caused the prices of the bonds that were sold at the previous lower rates to be down in value as much as negative 12% recently. It's actually been one of the worst declines in bond values in history. So even though bonds are safer investments than stocks, they are by no means risk-free. Just want to emphasize that. Okay. Let's see. Did I get that right? Yes, I did. Take a sip. Going to be down the stretch now. Getting close. Now let's talk about mutual funds. One of the last things, types of investments. They're another way to invest and diversify in the market and are often a newcomer's go-to for an introduction to investing. So what is a mutual fund? Well, it is essentially a money pool managed by a fund manager. The manager is responsible for investing the money into stocks and bonds, which means you do not have to monitor your investments as closely or often as you would if you own them all yourself individually. The plus side of choosing a mutual fund is that you can diversify without paying numerous commission fees to a stockbroker. This is because if you had to make individual investments, you'd end up paying a separate fee for each investment. One drawback to owning a mutual fund is that they cannot be liquidated until the market closes at 4 p.m. each business day, Monday through Friday. So if the market is falling quickly early in the day, like it did in March of 2020, when the pandemic hit, you can only put your order in to sell it at the end of the trading day, 4 p.m., because it will not be accessible to sell until the market closes. And of course, you could see substantial losses by that point. Another potential drawback to a taxable account with mutual funds in it is that since they are usually actively managed, more capital gains may be realized in any given year than if an ETF, which is an exchange traded fund, which is what I kind of prefer, were the investment of choice. However, most good mutual fund management teams, like the ones at Vanguard, BlackRock, and State Street, etc., are able to minimize these gains through creative and efficient investing. Okay, folks. Now that you have a basic understanding of the types of investments that normally go into a portfolio, let's take a look at the most common types of investment strategies that are employed in order to pursue investment returns today. Oh, no. Okay, final bullet point. Final bullet point, and this isn't a big one, because when I asked this, I want some answers. Come on. Final bullet point. Now, the types of investing strategies that are most commonly used are 1, passive investing. What did I just say? 1, passive investing. Set it and forget it. This is basically how Vanguard portfolios work today. 2, active investing. What did I say? 2, active investing. Now, asset managers make active choices on what to invest in and when. This causes investments in the portfolio to change periodically. It usually does not change asset allocation, though, which we'll discuss in a minute in the portfolio. So trades are usually made within the current asset allocation makeup. 3, tactical investing, or also known as quantitative investing. This is active management too, but it's executed by using algorithms that are fed market and or both economic data or metrics that trigger trades at predetermined thresholds. So human beings, although they make the trades, the actual algorithms dictate when to make them. These portfolios do not have static asset allocation to provide risk mitigation. Instead, they provide ranges of asset allocations. So a moderate portfolio, instead of being set at 50% equities and 50% bonds, it might have a range of between 70% equities and even 0% equities at some point in time, depending on what the market and economic data tells it. In fact, a lot of them these days are at 0 equities. They might be invested mainly in cash equivalents. Depends on the risk tolerance that is invested into. Fourth and final bullet point type of investment strategy. Protected, or otherwise known as hedged investing. That's called protected or hedged investing. This is done by using stock options to protect from losses in the portfolio. This is most commonly seen in fixed index annuities and index universal life insurance, but also can be done outside of those types of vehicles. These last two types of investing strategies are the ones that our firm has been leaning toward over the last couple of years due to the volatile nature of the market. The markets. So let's take a look at why that is. Now, traditionally, until now, most portfolios have had passive asset allocation choices based on either investors' personal risk tolerance, like these. So in order to accommodate large numbers of investors, every asset manager provides several investment portfolios that have different blended proportions of the asset classes that, when together, create a specific risk level for the portfolio in advance. So let's take a look at what they've been. They generally break down like this. Can be as conservative as 100% fixed income. Fixed income is just another way to say bonds. Various kinds of bonds. That's considered highly conservative. But there's portfolios that could also be 80% fixed income and 20% equities. That's considered conservative. And then there's 60% fixed income and 40% equities, which is considered moderate conservative. Then, of course, 50-50 for the fixed income and equities, and that's just considered moderate. And then there's 40% fixed income and 60% equities, and that's considered moderately aggressive. Then there's 20% fixed income or bonds, 80% equities, and that's considered aggressive. And then there's the highest aggressive type, which is 100% equities. Now, there are always some slight variations from these predetermined asset allocations, but these are the most standard combinations that you will see out there today with most money managers. And they're static. They stay in those proportions the whole time you're investing. There are always some, but also the individual investments within these asset classes vary tremendously from one portfolio to the next and from one asset manager to the next as well. So although they may be made up of bonds and equities, what the actual bonds and equities are will be completely different from one money manager to the next. However, whichever investments that they use, they will usually fit it into either fixed income, bonds, or the equity stock asset classes. So they're always going to stay with that proportion, whether it be 60% equities, 40% bonds, or 50% equities and 50% bonds. They might change those bonds or those equities inside those proportions, but they're going to stay within those proportions. I refer to this as a static portfolio, or a static type portfolio, referring to the actual, or strategic it's sometimes called, which I don't like quite as much. Just referring to the proportion of bonds to equities. Also, there will usually be somewhere around 2% in cash or cash equivalents in order to keep some liquidity to be available for quick access to clients and portfolio periodic expenses in any given portfolio. So let's talk about active managed investing. That was passive. When it comes to actively managed investing, according to the University of Pennsylvania's Wharton at Work newsletter, actively managed investments charge larger fees to pay for the extensive research and analysis required to beat index returns. Few are able to beat the markets consistently, according to the Wharton faculty members. Over a recent 10-year period, active mutual fund managers' returns trailed passive funds consistently, says Kent Smetters, professor of business economics at Wharton. And on an after-tax basis, managers of stock funds for large and mid-sized companies produced lower returns than their index-styled competitors 97% of the time, while managers of small-cap stocks trailed 77% of the time. So it has been pretty well known out there that actively managed investors have not done very well against their passive counterparts. All right. So when it comes to investing, what historically has produced the best compound returns is the type of investing that minimizes the volatility of the portfolio, because it has produced higher compound returns versus average returns. Now, your first thought when it comes to this consideration might be, I didn't know that my portfolio's average return could be different from its compound return. But in fact, it actually can be. And you can only really differentiate this by comparing the actual total dollars earned between two different portfolios that have the same average return. Also, the variable that causes this anomaly to occur is the difference in volatility between two different portfolios. Well, let's look at that. In this slide, you can see this clearly when you compare the two different wavy lines that are representing two different portfolios on the top graph here. The orange wavy line, which represents the more volatile portfolios, has a range of plus 25 to negative 15%. This also works pretty much hand in hand with passive investing. So passive investing pretty much can just goes along with the risk tolerance, and the volatility ends up being a pretty wide range in most of those portfolios. So in any given year, in this example, it can be plus 25% to negative 15. Versus the gray wavy line has a range of plus 15% to negative 5%. And even though they both have an average simple return of 5% annually, the less volatile portfolio produces a 42.5% return, compounded return, which is actually a 5.3% compounded return annually over 8 years, over the same 8 years, versus only a 27.4%, or actually 3.4 annual compounded return in actual dollars with the gray, the one with the gray, the orange line. So the one with the gray line, even though it had lower returns, lower highs and lower lows, it actually ended up compounding close to 2% more annually than the one that had the higher returns, higher highs, and higher lows in the long run. Also, the spreadsheet below, you can see it here. See the green line? See where it's highlighted in yellow? Shows the numerical breakdown of how the two portfolios arrive at these different compounded returns. I created this spreadsheet just so I could actually see how this worked in dollars. And I must tell you that I was completely flabbergasted when I realized this several years ago. So at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk reward profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential overall return over the long run. Now, now that you've seen and you have a good idea why it's so important for your portfolio to have a good risk reward profile that keeps its volatility under control, you now know one of the main reasons why our firm has preferred and gravitated toward both the tactical and protected approaches toward investing over that traditional static asset allocation approach. That once was so reliable for so many investors. The bottom line is that one of the main priorities when it comes to tactical and protected management portfolios is to minimize volatility, which in doing so also mitigates the risk of the portfolio drastically as well. These types of investment strategies have been used at the institutional level for many years, but it has just become more accessible to the average investor through different third-party money managers over the last 10 or 15 years or so. So that's why we prefer the tactical and the protected investment strategies over the traditional static. And of course, active isn't even a consideration at this point, as far as I'm concerned. Finally, folks, if you came to this event with the idea that investing is risky and that it involves you tracking your contributions daily and trading based on trends to best monetize your investments, or maybe to find out if Bitcoin is the right investment for you, well, I'm sorry to tell you that even though a lot of money has been made in day trading and in novel investments like cryptocurrency, although not too much recently, over the years, when it comes to the average investors out there today, these things are just not reliable enough to advocate for the long term, as far as I'm concerned. Plus, when it comes to things like cryptocurrency, which is a very hot topic today, I still can't find any definitive research that has convinced me, and I've been looking for good reason to invest personally, that it is actually a good long-term investment for many reasons beyond the scope of this webinar today. So that's not to say that a very small percentage of someone's portfolio couldn't be allocated to it. I think higher risk investments can be allocated to some degree. It just hasn't proven itself long term as of yet when it comes to the rules of conventional investing, which in a nutshell are that an investment must show long-term earnings potential and prove that through the metrics it produces on a quarterly basis year over year. Sure, many people do this type of trading and investing, but unless you have the time and are willing to take the risk, buying low, selling high is not the best option for most investors. The average investor is looking for a return with a set it or forget it mentality for long-term gains. With the market average hanging around 7% based on traditional passive investing, you can expect whatever your investment now, expect whatever you invest now to gain in 30 years about 7 times or less that really your investment when you use a set it or forget it strategy. So it's my contention that due to the increased volatility in the equity and bond markets, today's investors have to start thinking outside the box if they want to have any chance of minimizing their risk and getting average returns that are anywhere close to what past investors have gotten. And this is why we have gravitated towards the investment strategies that we advocate. Now, if the thought of doing your own research and navigating investment opportunities is more work than you want to put into your investing, you may consider seeking out a financial advisor to help you decide on the best investments for you, your budget, and your financial goals. A financial advisor does come with a fee, though, typically some percentage of the value of your assets annually. But what you get out of it is a professional who will be actively monitoring, evaluating, and diversifying your investments, as well as your overall financial plan. If you decide to go this route, it is very important that you choose the right advisor for you. It is my recommendation to look for someone who emphasizes comprehensive and holistic financial planning versus someone who just manages investments. I say this because it is very important that all phases of your financial life, accumulation, deaccumulation, and legacy planning, for things to be most tax efficient when you pass your assets to your beneficiaries and or heirs. Folks, this concludes the workshop part of our webinar today. Ooh, right at 8 o'clock, right? Before we jump in, so we sincerely hope that that these investing insights that we have discussed with you today are as helpful to you as they have been with us and our clients. Also, before we jump into our 6-question quiz and our Q&A for it, I want to make a special offer to everyone who is attending our webinar today. I usually charge $4.99 for a full Investing Insights review, like we discussed today. But for everyone here with us on this webinar today, I'm offering a no obligation complimentary Investing Insights review, but only if you book it on my calendar before midnight tonight. However, if for some reason you can't book it tonight, I will still offer everyone on the webinar a 50% discount if you book it by Friday this week. Also, I want to take a minute to explain a little about what the review entails and what you can get out of it. So this is what it entails. First, there's 2 ways we can actually meet to do it. The first is online using Zoom, which is almost just like we're doing this webinar, but instead we'll both be able to see each other and hear each other, and it will be completely private. Second, or we can meet in person at our office in Fort Washington. It's just off the PA Turnpike. In order to schedule it, Rachel will be putting up a link in the comment box right now for you to book a 60-minute meeting on my calendar. If you do so before midnight tonight, the review will be completely free of charge for you. Now, second, then after you do that, we need to meet 2 times. We would meet the first time to gather all the information that I will need to do the review. And the second time we would then meet it and go over the results of it. Finally, what you can get out of this is a clear understanding of whether your current investment strategies are aligned with your investment goals and risk tolerance, and whether any of the investment concepts that we discussed today are more suited to do so. Okay, folks, we're now going to jump into our 6-question quiz and our Q&A questions before we wrap it up. So I hope you jotted down those bullet points. We're ready to get started, Rachel? All right. First question. What is the #1 most important rule to investing? What is the #1 most important rule to investing?
Bob got it.
Bob got it.
Yep.
All right, Bob. Patsy got it too. Bob's quick to the trigger there, Patsy. Those two go at it usually. Second question. What type of retirement account could be available to people at work? Bob's good. I think you got them pre-typed in there, Bob. Oh. Yes. Chevelle. I hope I'm pronouncing it. Got it as well. So, okay. Third question. What type of retirement account is available to all individuals with working income? Come on, Bob. Got to give somebody else a chance here, buddy.
Marty Peanut.
We're gonna have to make a decision on this at the end. By the way, if you do win any, please put in where you would like your $10 gift card to be from.
Mhm.
All right, going to get a little harder now. Fourth question. Name one of the two types of stocks that exist. Yes. Who got that first one?
Yeah.
Chevelle?
Yeah.
Chevelle. All right, good one. Beat you to it there, Bob. All right. Fifth question. Name the other very common investment option that is part of most portfolios and is considered a debt instrument. A bond, Chevelle, quick to the trigger. Final question. This is going to be a little tougher. Name one of the 4 types of investing strategies that we talked about. Oh, Bob. Active, passive.
Yeah.
I think we're going to give that one to Patsy, Bob. You just killed it a little too much. I hope you're okay with that. Thanks, buddy. All right. That was a good match, right? Little 3-way competition going on there. All right. So, you got any questions in that comment box, Rachel?
Let's see here.
Or in the Q&A? All right, Bob, we got you for Walmart. Chevelle, if you could put where you would like that from Amazon. Yeah, that's a good one. How about you, Patsy?
Okay.
Let's put them in. All right. What do you got for me, Rachel? Anything?
Yeah, I'm just writing this stuff down. Hold on. Are you a proponent of investing into individual stocks?
Am I a proponent of? Okay. So let's put it this way. Absolutely, I'm a proponent of. But only if you know what you're doing. You got to do a little research. Got to get on some of the investing websites like Morningstar. You got to read a book or two about the different types of metrics that are important when it comes to them. And if you can make an educated decision, then absolutely I'm a proponent. But I don't like to see anybody make bad timing choices, and not that you can time out stocks, because I don't believe in that either. but you can do it at times when metrics are better than other times. So, you know, sometimes that might take being patient. Right now, a lot of the stocks have great metrics and they've really came down, and a lot of the metrics that were high before, and it's probably a good time to buy a lot of stocks. But only the metrics would dictate that, in my opinion. Or if you research the company enough to know that you really have enough belief in their growth to go beyond what their metrics are, then yeah, by all means, you know, but do your homework. Okay, what do you got?
Okay, thanks, one. Do you prefer mutual funds over stocks and bonds?
Well, okay, so let me tell you what I tell most other people, okay? So I do prefer mutual funds for the average person versus individual stocks and bonds, absolutely, because most mutual funds invest in thousands of stocks and bonds, and those choices are made by real professionals. If you go with some of the bigger names like, you know, Vanguard and BlackRock, and like I mentioned, State Street, or any number of real good ones that are out there. So I do, but I actually prefer ETFs over mutual funds, exchange traded funds, because they trade like stocks, and then you can get out of one in a second versus having to wait to the end of the day in a mutual fund. But if a mutual fund's being invested in a 401k and a person has a long time before their retirement, then that's not going to matter that much. And a mutual fund is good as, you know, is just as good in my opinion. So that's kind of my take on it.
Right. Okay. So, a couple more. You want to do a couple more?
Yeah.
Okay. When would you say is the best time to start saving?
It's a little bit of a loaded question. I think you should, now is always the best time, but particularly right now, while the markets are down, it's very opportune, because you can buy stock cheaper, you can buy investments cheaper, mutual funds, everything cheaper. So that's great. If you're buying stock, I'd learn how to read a chart, and I'd learn how, when there's pullbacks on the stock, even though the market might be up, there's always fluctuations. When there's a pullback, that's usually the best time to buy an equity. And of course, bonds, I mean, obviously when the rates are up is when you want to buy them, because when the rates go down, the values go up of the stocks, of the bonds that have higher coupon rates. So, you know, do your homework a little bit, but, you know, if you're going to be investing frequently, like every week at work or every month or whatever, on a regular basis, then I would just do it, because you're going to grab all those periods of time. But if you got a large sum of money and you're not moving it, and it's been sitting in cash for a long time, and you have the flexibility, well, then maybe then you can time it into the market over time, something like that, to not to time it, but to give yourself higher chances to grab it, do those things when the timing is better for it. All right, last one.
Okay, last one. Is it better to buy and hold, or do active trading?
But buy and hold is, obviously an old tradition, tried and true, for the most part. It's usually passive. If you're buying individual stocks and you got stocks with long history, then absolutely buy and hold. If you're in ETFs or mutual funds or anything like that, and you're broken up in an asset allocation type of a portfolio where it's been given a risk tolerance or a risk level, like the ones I mentioned, then again, I'm a proponent of now, more of a proponent of the tactical, quantitative and protective investing, which is kind of technically active, but it's not being done by people. There's, there's metrics and computers that feed those metrics that have great histories to them. So active in that way, yes, but not with people just picking them based on their instincts and that. We've seen that hasn't worked as well. So as compared to buy and hold and that type of active, I'd say buy and hold. But compared to the other types that I'm more of a proponent of, the tactical and the protected investing, I'd say I'd go with active in that regard versus buy and hold if it's that type of investing. So I don't know if that's answers the question right, but it's a little bit of a moving target there. But that's my take on it.
All right. Well, that was it. That was my fun.
All right. Okay. What are we doing here? Okay, so first you can see Rachel's going to also put the resources up to this presentation if you haven't already done so, right, Rachel?
I'm doing it right now.
And also a link for the 60-minute meeting and the 15-minute meeting. 15 meeting, it's just a phone call meeting. If you have questions or anything, it's not part of this. And you just want to have a quick, dialogue on that. She's going to put that link up, put that on my calendar. So that concludes our workshop for today.
Okay.
I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic. I truly commend you guys. And I want to remind you that if you have any questions related to this topic we covered today, or our offer of the no obligation complimentary investing insights review, or if we did not answer your question in that comment box, which I don't think we covered everything there, or anything else that's for that matter, and you'd like to discuss it with us further, Rachel has already put up those links for the 15-minute and 60-minute meetings, and you can book them at your convenience. Well, that's all for today, folks. On behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, wait, Rachel, and myself, Brian Dougherty of PLC Financial Solutions, located in Fort Washington, PA. Also, you can reach out to us at either 215-804-9708 by phone or at info@plcfs.com. Like saying that like that. Or to make it even easier, just go to our website at plcfs.com. And all our information is always there. Also, please mark Tuesday, July 26, 2022 at 7 p.m. on your calendar for our next webinar. Remember, we do them on the last Tuesday of every month. Have a great upcoming month, and we will see you guys then. Good night.
Night, everybody.